Hey everyone, welcome back to Corporate Decoder. You know we love digging into these dense financial reports, but sometimes you get a whole bunch of them at once and it's like, whoa, what are we even looking at? Today we have a doozy, a whole stack of reports from Principal Variable Contracts Funds Inc. Now, without getting too deep into the weeds, think of these like different investment accounts your employer might offer, each with its own flavor and strategy. We're going to decode what these reports are telling us about how these accounts are doing. Alright, so we're looking at a bunch of semi-annual shareholder reports for the period ending June 30, 2025. It's essentially a checkup on how these investment funds are performing. We'll be focusing on the numbers, the financial tables, and trying to figure out what they actually mean for the folks who invest in them. Let's start with the blue chip account. For a hypothetical $10,000 investment, the costs for the last 6 months were about $16. That's a pretty small amount, less than $1 percentage-wise. Now, this report is only for 6 months from April to June, and expenses for a full year would be higher. The fund had $26,925,000 in net assets. That's not a massive fund, but it also has 42 portfolio holdings. The portfolio turnover rate, which measures how often they buy and sell investments, was about 31.9%. This usually means they're not aggressively trading, which can be good for keeping costs down. Diving into how the money is invested, almost all of it, 99.33%, is in common stocks. That means they're mostly betting on companies, the actual businesses themselves. The remaining little bit, 0.67%, is in investment companies, which could be other types of funds, and then pretty much nothing in other assets or liabilities. Looking at the sectors, technology is the biggest piece at 27%, followed by financials at about 24%, and then communications at over 24%, and then communications at over 21%. These are pretty typical sectors for a growth-oriented account focused on stocks. Now, let's switch gears to the bond market index account class 1. For a $10,000 investment, the costs were even lower, just $8, which comes out to 0.15%. This account is much more focused on bonds and has nearly $2 billion in net assets. Its portfolio turnover rate is a bit higher at 44.8%. Here, the big story is bonds, making up almost 70% of the investments. Even more specifically, US government and government agency obligations are a huge chunk at nearly 70%, with regular bonds making up another 28.71%. So this account is heavily weighted towards fixed income and particularly government-backed debt, which is generally considered safer. The investment companies and municipal bonds are very small pieces. The sector breakdown here is dominated by government at 48.26% and mortgage securities at 26%. The other sectors like financials, consumer non-cyclical utilities, and so on are all quite small. This aligns perfectly with a bond-focused strategy, emphasizing lower risk government and mortgage-related investments. Next up is the Core Plus Bond Account Class 1. For our hypothetical 10 grand, the costs were $25 or 0.49%. This fund has over $200 million in net assets and a very high portfolio turnover rate of over 200%. That's a lot of trading. For this account, bonds are still the main game at 62%, but US government and agency obligations are a much smaller piece this time at around 35%. The key here is that over 7% is in investment companies and a whopping 7.26% is in other assets and liabilities, which the report clarifies includes derivatives. That's a big red flag or a big opportunity depending on what those derivatives are doing. The sector allocation is interesting. Mortgage-backed securities are the biggest at over 33%, followed by financials and then government. But then you have about 5% in exchange-traded funds and another 20% in other assets and liabilities, which again is where derivatives live. This high turnover and significant derivative exposure, coupled with those other assets and liabilities, it suggests a more active and potentially riskier bond strategy compared to the bond market index account we just looked at. Let's check out the diversified balanced account class 1 with a super low cost of just $3 or 0.05% for our $10,000 investment. This fund has over $550 million in net assets. Its holdings are incredibly concentrated with only 5 portfolio holdings. The turnover rate is also quite low at 13.7%. Crow portfolio allocations, this is quite unique. 100.02% of the assets are in investment companies. That essentially means this fund invests almost entirely in other funds. It's like a fund of funds. Scroll for fund type, allocation tree broken down by fund type. Nearly 50% is in fixed income funds, 43% in domestic equity funds, and about 7% in international equity funds. So even though it's called diversified balanced, it's balanced by investing in a mix of other asset types through other funds. Now, for the large cap S&P 500 index account. Costs for a $10,000 investment were only $10, which is 0.20%. This is a massive fund with over $2.5 billion in net assets. Its portfolio turnover rate is incredibly low at 1.9%, which is typical for an index fund that just aims to track the S&P 500. Scroll portfolio allocation, see once again, almost all of it is in common stocks at 97.21%, with a small amount in investment companies. This is what you'd expect, mostly investing directly in the stocks that make up the S&P 500 index itself. Scroll sector allocation chips. The sector breakdown is heavily tilted towards technology at about 31%, followed by communications and financials, each around 15%. This also mirrors the S&P 500 sector weightings, showing the fund is doing exactly what its name suggests, tracking the index. Scroll Class 1 Principal Capital Appreciation Account. Class 1 costs here were $32 for our $10,000 investment. That's 0.63%. It has over $230 million in net assets and a portfolio turnover rate of around 59%. Suggesting a more active growth strategy than the index funds. Scroll portfolio allocation caption. This account is heavily invested in common stocks at nearly 99.6%. Again, very focused on owning businesses directly. Scroll sector allocation to sector breakdown shows a heavy concentration in technology at nearly 30%, then communications and consumer cyclical, each around 15%. This is a clear focus on growth-oriented sectors. Scroll Class 1 Principal Lifetime 2020 account. So moving on to the life cycle funds like the Principal Lifetime 2020 account. For a $10,000 investment, the costs were almost nothing, just $1, which is 0.01%. These funds are designed to adjust their investment mix over time as you near a certain retirement year. This fund has over $140 million in net assets and a portfolio turnover rate of 42.7%. Scroll portfolio allocation chinned. As expected, they are entirely invested in investment companies, meaning this is another fund of funds. Scroll fund type allocation check. Looking at the fund types, it's a mix of fixed income funds at over 57%, domestic equity funds at around 30%, and international equity funds making up almost 13%. This is a typical asset allocation for a target date fund as you get closer to retirement, emphasizing stability with a heavy dose of fixed income. Scroll Class 1 Sound Balance Portfolio Class. Finally, let's look at the Sound Balance Portfolio Class 1. The costs here for our $10,000 investment were $12 or 0.23%. This fund is quite large with over $570 million in net assets and a portfolio turnover rate around 48%. Scroll portfolio allocation seed, like the diversified balanced account. This one is also almost entirely invested in investment companies, meaning it's a fund of funds at over 100%. Scroll for fund type allocation caption. The breakdown shows 55.53% in domestic equity funds, 32.50% in fixed income funds, and just under 9% in international equity funds. This implies a balanced approach, but again achieved by investing in other funds. Overall, what we're seeing is a consistent theme here. Many of these accounts are actually funds of funds, meaning they invest in other funds to achieve their diversification. The costs vary quite a bit from incredibly low, like 0.01% for some of the lifetime accounts, to much higher, like 1.16% for global emerging markets. The blue chip account and the S&P 500 index account seem quite solid with low costs and broad diversification. However, when you see those large allocations to other assets and liabilities and high turnover rates, as we saw in the Core Plus bond account, it signals a more complex and potentially less predictable strategy. It's always good to understand how your money is being invested and what you're paying for it. Alright, that's our deep dive into these Principal Variable Contracts Funds reports. What's your take on these different investment strategies and their costs? Let us know in the comments below. If this breakdown helped shine a light on these filings, please hit that like button and subscribe for more corporate insights. And remember to join our Discord community linked in the description for more in-depth discussions. Thanks for watching and I'll see you in the next video.